You get your paycheck, you worked the hours, you earned the promotion. Maybe you even negotiated that raise. On paper, your income looks solid. You're officially middle class. And yet, when the money hits your bank account, it already feels smaller than it should. Federal taxes, state taxes, Social Security, Medicare, health insurance deductions. Before you've paid rent or bought groceries, a meaningful percentage is gone. So here's the uncomfortable question. Is the middle class being directly pushed into poverty? Or is it being slowly compressed by a system that taxes labor consistently while rewarding leverage quietly? This isn't a rage argument, it's a structural analysis. Because once you break down how taxation, inflation, and policy layering interact, the squeeze starts to make sense. The layered tax effect. When people talk about taxes, they usually focus on income tax brackets. But income tax is only the first layer. Middle-class households typically face multiple overlapping forms of taxation at once. There is federal income tax on wages. In many states, there is state income tax as well. Then payroll taxes fund Social Security and Medicare. After that, when income is spent, sales taxes apply. If a household owns a home, property taxes apply every single year. There are also fuel taxes, vehicle registration fees, and local levies folded into utilities and services. None of these individually seem catastrophic, but the cumulative effect is significant. You are taxed when you earn, you are taxed when you spend, you are taxed when you own. The pressure doesn't come from one dramatic deduction, it comes from stacking. A concrete income breakdown. Let's make this tangible. Imagine a household earning $100,000 per year. That sounds comfortable in many parts of the country. After federal income taxes and payroll taxes alone, that household may see take-home pay drop to around $75,000 or less, depending on deductions and state taxes. In states with income tax, the number can fall closer to $70,000. Now subtract major living costs. Housing in many regions easily consumes $25,000 to $35,000 annually. Childcare can cost $15,000 to $20,000 per year. Health insurance premiums and out-of-pocket expenses may total $10,000 or more. Transportation costs, including car payments, insurance, fuel, and maintenance, can add another $10,000 to $15,000. On paper, six figures look strong. In practice, the margin often feels tight. That's compression in action. Labor versus capital, the structural divide. One of the most important distinctions in the tax system is how income is categorized. Middle-class households primarily earn income through wages reported on W-2 forms. Wage income is taxed directly and immediately. It is predictable. It is difficult to shield beyond standard retirement accounts and deductions. In contrast, higher income households often derive significant portions of income from capital gains, dividends, and business ownership structures. Long-term capital gains are often taxed at lower rates than ordinary income. Business owners can deduct expenses in ways wage earners cannot. Income can sometimes be deferred or strategically structured. The middle class relies primarily on labor, and labor is taxed consistently at the source. Bracket creep and real purchasing power. Now add inflation to the equation. Suppose your income rises from $85,000 to $95,000 over several years. That feels like progress. But if tax brackets do not perfectly adjust for inflation, that raise may push a portion of your income into a higher marginal bracket. At the same time, your purchasing power may not meaningfully improve. Groceries cost more, insurance cost more, housing cost more, utilities rise. You earn more nominally but do not feel richer in real terms. This is often referred to as bracket creep. It does not require a new tax law. It happens gradually as wages and prices rise. And because it is gradual, it rarely triggers public alarm. It simply reduces flexibility year after year. The phase-out cliff. Another structural pressure point is benefit phase-outs. Many tax credits and assistance programs are income tested. Below certain thresholds, households qualify for credits such as the child tax credit, education credits, or healthcare subsidies. But as income rises, these benefits begin to phase out. Sometimes the phase-out is gradual, sometimes it is steep. In certain cases, a relatively small raise can result in losing thousands of dollars in credits or subsidies. This creates what economists call marginal cliffs. Earning slightly more can result in keeping less than expected once benefits are reduced. For middle-class households hovering near eligibility thresholds, this can make upward mobility feel frustrating rather than empowering. Payroll taxes and the wage base cap. Payroll taxes fund Social Security and Medicare. These taxes apply to wage income up to a certain cap for Social Security. After that cap is reached, additional income is not subject to that portion of payroll tax. High earners still pay more total dollars overall. However, proportionally, middle-class earners often pay payroll taxes on nearly all of their income, while those earning far above the cap pay it on a smaller percentage of total earnings once they exceed the threshold. The distinction is not about total dollars paid. It is about proportional impact relative to income, and proportional impact shapes household budgets. Property taxes and the ownership illusion.
Homeownership is often positioned as the foundation of middle-class wealth, but property taxes remain even after the mortgage is paid off. In many areas, property taxes increase as home values rise. If your home appreciates significantly, your annual tax obligation often rises alongside it. The asset grows in value, but so does the cost of holding it. For retirees or households on fixed incomes, rising property taxes can create ongoing financial pressure even when the home is fully owned. The asset provides equity, but it does not eliminate recurring tax obligations. Consumption taxes and inflation. After income is taxed, consumption is taxed again. Sales tax applies to most purchases. Fuel taxes apply to transportation. Local taxes are embedded in utility bills and services. When inflation pushes prices upward, tax revenue collected from consumption rises automatically. As goods and services become more expensive, the tax collected on those goods increases as well. The result is that rising costs do not just affect expenses, they also affect the amount of tax collected on everyday life. Structural compression, not conspiracy. It is important to remain analytical. Tax systems are built incrementally over decades. Policies are layered one on top of another. Each may serve a purpose. The compression effect often emerges not from a single malicious design, but from overlapping structures. Income is taxed first, spending is taxed again, ownership is taxed annually, benefits are income tested and phase out. The system rewards scale and ownership, it taxes labor consistently. The middle class lives primarily on labor. That structural reality shapes long-term outcomes.
Why ownership changes the equation. Labor earns linear income. Ownership creates non-linear growth. Labor is limited by time. Ownership benefits from scale. Assets appreciate. Capital compounds. Businesses expand beyond hours worked. When you own productive assets, inflation can become a tailwind instead of a headwind. Rising prices often lift certain assets along with them. This is not about resentment. It is about positioning within the structure. Ownership does not eliminate taxation, but it changes timing, leverage, and compounding. And over decades, that difference matters. The leverage divide. The middle class is not collapsing because it lacks discipline. It struggles when it stays positioned only on the labor side of the equation. Labor is necessary. It builds skill and stability. But by design, it is taxed first, adjusted slowly, and capped by hours. Ownership operates differently. It scales. It compounds. It separates income from time. If your financial life depends entirely on earned income, your exposure to layered taxation and inflation remains constant. If even a portion shifts towards assets, equity, intellectual property, or scalable systems, the trajectory changes. The goal is not to stop working. The goal is to stop relying only on work. The long-term math. Compression does not destroy stability overnight. It reduces flexibility.
Is the middle class being directly taxed into poverty overnight? No. But is it being gradually compressed by layered taxation, inflation, and limited leverage while relying primarily on wage income? In many cases, yes. The squeeze is cumulative, not dramatic, and cumulative pressure shapes decades. The middle class does not lose because it works too little. It struggles when it never moves beyond labor into leverage. Learn the structure, build assets, shift from earning alone to owning, because over time, ownership compounds. And labor, by itself, rarely does. If this breakdown helped clarify the mechanics behind the squeeze, drop a comment below. And if you want more deep dives into money, systems, and long-term strategy, make sure to like and subscribe.